Well, Jared, thanks a lot for coming to the Judgment Call podcast. I really appreciate that.
Yeah.
Hey, thanks for taking the time. And you have a really interesting history, and it's something that's becoming a bit of a theme too. Is you started in an investment bank, and you worked with Lehman Brothers. Then you wrote a book. You became an author, and now you're an internet personality. You run your own internet business, your own content business. Maybe you can tell us a little bit more about this transition, how this came upon, and how do you feel? Was it the right choice looking back, or do you feel like, well, no, I want to go back to an investment bank?
No, it was absolutely the right choice. It was funny because I was talking to my old boss at Lehman. This is the guy that I worked for 2001, 2002. And he told me a story of, when I worked for him, we used to get the Gartman letter. I don't know if you know Dennis Gartman, but we used to get the Gartman letter at Lehman Brothers. And he had probably the biggest financial newsletter. It was a daily letter. And I used to get this stuff, and I liked it. I didn't, I didn't think his writing was the best, but I said, this is an amazing business. I was like, you can just get paid to write about finance. I had never heard of this before. So around 2003, I had this idea in my head that I wanted to write a financial newsletter. So I had some ideas, and my initial idea was it would be sort of a retail newsletter. I would charge a very small amount of money, about $150 a year. And I would do personal finance stuff, and then I would do seminars and stuff like that. And I figured if I had 1,000 subscribers, I would make $150,000 a year, and that would be enough. And then what happened was, while I was at Lehman, I was put in charge of the ETF desk, and I was told to just grow the business because the business was very small. They said, grow the business. So my idea was to do that through writing. So I started writing market commentary and sending it out to people, and it was very popular, and it grew and it grew and it grew. So by the time the bankruptcy came around, I had several thousand people on my list, and I said, I can easily monetize this. So the day of the bankruptcy, I sent out a message. I said, I'm going to start a newsletter, and hundreds of people said, I'll sign up. So I quit Lehman Brothers and I started the business. I formed an LLC and I got some office space. And about 6 weeks later, I started sending out content again. And I got a few hundred people to sign up. And that was the beginning of the newsletter. So that was in 2008. And about that time, I was also approached to write a book about my time at Lehman Brothers. There was a literary agent that found me and asked me to write a book about it. And initially I said no, but 6 months later I came around and I said yes. So while the early days of writing the newsletter, I was writing this book, and that came out in 2011. So there's just been a bunch of stuff since then. I started writing for Malden Economics in 2014. I wrote another book in 2016. I'm an op-ed columnist at Bloomberg. I've taught finance at the undergraduate level and graduate level at school. And I had a radio show for the last 2 years, which is coming to an end tonight. But we're going to convert that into a podcast. And my goal is to make this the #1 finance podcast. So.
Yeah, that's really ambitious. Yeah, I mean, you're really all in on becoming not just an internet personality, but really making this content machine work, right?
Yeah.
A lot of people, from the VC business, they go into Substack, right? That seems to be the technology platform to use, and also the idea that you pay a relatively small amount, and it's geared towards consumers. Is that still the model that you're using, or you switch to a B2B model where you basically do it for hedge funds and other investment banks, smaller investment banks, family offices?
I do both.
Okay.
My customers, I have institutional customers and I have retail customers. So.
Yeah.
In terms of Substack, I don't use Substack. I use a different proprietary system. Substack takes 10% of revenue, so that's a little bit much for me. The nice thing about Substack is that they do handle all the payments and stuff like that. So I do that myself now, which is a little bit time consuming. But yeah.
Yeah. When you look back, do you feel like the world of finance has changed quite a bit, and that there's more knowledge, or people are more aware of what's going on out there? Or do you think we're still looking into a similar perplexing environment as it was 10 years ago? It's just we all have more opinions about it.
Well, I think more people are engaged in finance, but I would say that a lot of people have learned a lot of bad ideas and bad habits. The meme stocks are a pretty good example. I have a Coast Guard friend on Facebook who trades the meme stocks. He's always posting about AMC and stuff like that. And he says these words like I've never heard before. He talks about like holding the line and ladder attack and stuff like that. I'm like,
Yeah,
I don't know,
yeah,
I don't know what this is, but it's not finance. Like I don't know what you're doing, but this isn't the right way to learn things.
yeah,
So that was, so I formed this entity 2 years ago called Jared Dillian Money, and that was where the radio show came from. I did the radio show under Jared Dillian Money, and this is a personal finance platform. So really teaching the basics, not just about investments, but also about debt and credit cards and mortgages and stuff like that. So that's what I've been doing for the past 2 years.
yeah. Well, I think what a lot of people are looking for, and I think this is where the meme stocks came from, is this call option, right? So this really high is it beta? You want something that moves very much, even if the stock doesn't move so much, right? So it doesn't. It's more of a big gambling, right? But gambling not in that sense that the hedge funds always win. It's something where you can actually we have a weapon that works seemingly enough. We've seen this earlier this year, where you as a 20-year-old have a big enough weapon you can become a millionaire overnight, and the hedge funds give you that money, and that's pretty rare, right? I don't remember many of those situations in the last 10 years when it seemed like the hedge funds are at a disadvantage, at least momentarily.
No, I mean I think that's a narrative that got put forth after the GameStop incident. I don't think. I mean, look, there were a couple of hedge funds that were harmed by that move in GameStop, but I can tell you that retail investors, if you're trading call options on GameStop through Robinhood, people are making money off of you. The market
Yeah,
maker behind those trades is Citadel. They have some very sophisticated people who understand volatility, who know how to model a volatility surface. Like, I mean, yes, like if you buy a call option on GameStop and it goes up very quickly, you'll make money, but you're at a huge disadvantage.
yeah. So it isn't something you can actually win at least. I mean, the odds are definitely against you, right? This hasn't changed.
I
This,
think I think there was a short period of time, about 4 or 5 months ago, 6 months ago, when you could win at it, but I think that window is closed.
yeah, yeah. I feel the same thing. When when you when you wrote two books by now, you wrote first something that is more of a description of what happened at Lehman, and then it's a novel that you wrote later on that is complete fiction, I assume. I don't know how many facts are in that novel. How does that compare? How was it harder to write a novel than the accounts that you gave for Lehman, or do you feel it's the same amount of effort?
Oh, it was much harder to write a novel. I mean, just to put this in perspective, Street Freak, my first book, the memoir, it was 135,000 words, and I wrote it in 8 months. All the Evil of This World, which is my novel, is 70,000 words, and I wrote it in 5 years. It was
Yeah,
much harder, much
yeah.
harder.
Is that because you just wanted to do it perfect? Like we noticed from Jordan Peterson, his first book took him 20 years to write because he rewrote it literally every week. Do you wanted to get the narrative perfect, or because there were so many layers you had to go through?
No, I mean, I was a perfectionist about it, but the creative process when it comes to actually, you know, dreaming up events and places and people you've never seen before, it's just a lot slower and it's a lot harder. I tell
Yeah,
people like that book is the hardest thing I've ever done, and I never want to write fiction again. Like it's too hard, but at the same time, I'm the most proud of it. I really think All the Evil of This World is an amazing book, and it's the best thing I've ever done.
what is it about? What story are you illustrating?
So it's about a trade that takes place March 2nd, the year 2000. It's about when 3Com spun off Palm. I don't know if you remember Palm Pilots, but from
Yeah.
20 years ago. So it was a spin-off trade, and it's an options trade that takes place on 3Com. But it involves seven different people, from a clerk on the exchange to a broker on the exchange to a market maker at a bank to a hedge fund portfolio manager. Seven different people, and it's just each chapter is their story, and they're all interconnected. And each chapter is written in a different voice as to that person's personality. So each one is written completely different. It was the most ambitious thing that I could possibly do, and the engineering behind it was very difficult. But it worked out.
And it comes to a common conclusion, so they all see this through their own perspective, but there's a common conclusion at the end.
Yep.
Can you
Yep.
can you say that without spoiling the book?
Yep.
That sounds really interesting. I think there was a bunch of movies, right? They give you something from a very different perspective, and you can't really grasp who is who initially. I think there was the latest movie is Jason Statham, and I think it takes you a while to get into that sense of what's going on in that book, and it's hard to get to keep that narrative up and make it interesting enough for readers or for viewers. But then it has this amazing effect that you're like, whoa, I didn't see that coming, right? It's something that I couldn't predict as a reader, which is really rare, because I think a lot of people with the media overconsumption, they know what's going on. You see a TV show and you have seen this ending like 100 times.
Yeah.
Going a bit more into the finance topic, and you do daily commentary, what's your own personal opinion or something you've learned over time about inflation? And it's this big debate, and we had deflation versus inflation was actually a big topic. And we now feel the majority has shifted to some form of inflation. Nobody knows how much it is. What is your personal opinion? Where will this end, and how high will inflation go, or will we just see inflation disappearing?
I'm very much in the inflation camp. I actually, on my radio show last night, I interviewed Peter Atwater, who is at Financial Insights, and he really studies behavior and psychology and stuff like that in the markets. And I said to Peter, I was like, I think inflation is 90% a psychological phenomenon. And he says, I disagree with you. I think it's 100%. So what's happened in the last year is we've had a reversal of 40 years of disinflationary psychology, and we suddenly switched to an inflationary psychology. So this is how this works. If you think that there is going to be inflation, if you think prices are going to rise, if you think there are going to be shortages, then you accelerate economic activity. You buy more of things, you buy faster, and everybody doing this together drives prices up. So this, what happened when Volcker became Fed chair back in 1979, it was about reversing the psychology, and he had to raise interest rates a lot and crush the economy in order to reverse that psychology. So there's no appetite to do that right now. So, inflation is 5% and change. It's undoubtedly going to go higher. I don't know how fast it's going to go higher, but it will go higher.
What I find mesmerizing, and I agree with you, it's definitely, there's a lot of psychology in there. What I find mesmerizing is that we see bond yields that haven't moved at all, right there. Like 10-year bond is 0.2%. If you are a somewhat rational investor, how can you, with 5% projected inflation per year, right? So that's at least 30-40% of your bond that goes away after a 5-year period. Over 10 years, even worse. How would you even think about accepting this rate? Like, well, why does this market even exist if the yields are so low? Everybody should have gone away, right? This money should be gone, and I don't know where it would go into, whatever, buying a factory in Thailand, or where it should be.
Yeah, I mean, rates should be higher. Interest rates are a function of a couple of things: the supply and demand for loanable funds. They're also a function of the supply and demand for treasury securities. I mean, ultimately, like, if there's more demand for bonds, and it doesn't necessarily have to come from U.S. investors. It can come from overseas or wherever, also from the Fed. I mean, the Fed is still buying, $120 billion a month. So, I mean, that's where the demand's coming from. So it's really, this is, you've identified a mispriced security. The question is, can you do anything about it? Well, you can just avoid bonds and invest in stocks and commodities and real estate.
Yeah, we had Harley on, and his ETF is kind of a call option for increasing interest rates over the next couple of years, and it's a slow moving. Like, you don't lose a ton, you don't have a huge negative carry, so to speak, right? You only lose a little bit every year, and I think everyone agrees with this, but obviously it's down so far, right? So the last 12 months it hasn't done so well because the yields haven't really budged at all. I find this mesmerizing, and I agree with you. Maybe it's the Fed who creates all this demand, But I don't know if even the Fed has enough firepower for this, right? It seems to be a gigantic move because it should be more like 5 or 6% yields for 10 years. I think that's what all the psychology of most investors is now, right? If we assume the psychology of most traders already changed to such a high inflation expectation.
Yeah, yeah. No, I mean, this move in rates from 1.8 to 1.15. A lot of people, I mean, most people don't really know why this has happened. I mean, even the people predicting lower rates don't even really know why this has happened. So nobody has nobody
Yeah.
has a good explanation for it.
Yeah. Yeah. But do you feel like we see much lower rates and yields first? I mean, effective rates before we see higher inflation priced in, or we will definitely see interest rates going up priced in?
I have pretty high conviction that interest rates have bottomed.
Yeah.
And I think they will go higher. I don't know when that'll happen or how fast it'll happen. I also don't know what the catalyst will be, but I do think rates have bottomed.
Yeah. When we go into another topic that a lot of people are kind of worried about, and I've been very worried vocally on the podcast, is we've seen GDP growth relatively slow over the years, and we've really seen a population isn't growing as much. The GDP growth, we have population growth, and we have productivity growth. These two get combined, right? And population growth has slowed quite a bit. That's one part of it. But also it seems like productivity growth, at least the way we measure it, might be just a measurement problem. Productivity growth and that speed of deals these days, it hasn't been what we expected it to be over the last 20 years. And we see that people seemingly have a better lifestyle. They have way more information. They have all these entertainment options, but we don't feel like we get much more for the same amount of investment. And that's the lacking productivity growth. Do you feel like A, this is real? And B, is this something we can do about it? And should we do something about it?
No, I think it is real. I heard something interesting. I don't remember who said it, but if we had these massive productivity gains 20 years ago, back when the internet first came around, and it dramatically increased productivity. We were having productivity growth of like 6%, and that's gone down over time. And you'd say, well, technology has gotten so much better. Well, the way people use technology has changed. For example, you used to work an 8-hour day, okay, and you would work for 8 hours. And now people work for 4 hours and they're on Facebook and Twitter for 4 hours. So they work the same amount of time, but the internet has created diversions where they're actually not being as productive. Okay. And if you think about GDP, all it really is the number of people working times how many hours they work times the productivity. And if GDP growth is slowing, I mean, one of the things you identified is population growth is slowing down. Number two, how many hours they work. People are simply working less. Average hourly earnings has gone down. You hear these discussions about working 4-day weeks and stuff like that. People work way less than they did 20 years ago. And we just talked about the productivity part of it. So, yeah, I mean, we used to have a consistent GDP growth of about 4% a quarter. Now it's about 2 to 3% a quarter. And if you look at Europe and Japan, it's lower than that. And that's where we're going.
Yeah. Europe and Japan, they barely moved the last 10 years at least, right? So it's like 1% is already an achievement on a quarterly basis. Do you feel like there's something that policy-wise we could do? I mean, I always feel like capital allocation is broken. That's why we have such low productivity growth, because we put it in enterprises that already have way too much money, and we give them almost interest-free money, and it is almost interest-free. And but they don't have a lot of opportunities to grow as much. I mean, they're still growing on a total basis, but on a percentage basis, they're not growing as much. And we kind of price out all the other businesses, smaller, medium-sized companies. Basically, anything that's not in the S&P 500 doesn't have a chance to survive anymore. That's a very harsh picture. But that's sometimes how it appears to me, and that's where the capital should go, because there it gives you a higher rate of return. But somehow that's not, if my thesis is right, then why hasn't it transpired to other investors, right? Everyone is into this big trend following, bigger, 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 which makes sense to an extent, right? But it's like this, the stock market is trend following, the venture market is trend following. Nobody tries something new, it seems, from time to time.
Well, I think that's kind of reversing a little bit. I mean, we had a bit of reversal between big stocks and small stocks back about 6 to 9 months ago, and you saw a period of time where small cap stocks were outperforming, and then it kind of went sideways for a little bit. But I think it's going to happen again. Yeah, I mean, you've seen some crazy stuff because big tech companies, like you said, basically have a zero cost of capital. And by the way, when companies, if they have a zero cost of capital and they don't have any attractive investment opportunities, then they buy back stock. And that's another thing that's been going on for the last 10 years.
Yeah. Well, when you think of the buyback of stocks, do you think that is immediately negative for productivity growth?
I don't think it's negative or positive. I don't think there's a relationship there.
Okay.
I don't know.
It's just because management, all they really have to do is buy back their stock, right? To get the stock price up and get their compensation. They don't have to, in a way, don't have to do anything, right? That's the basic relationship there. That's basically broken. So management is disincentivized to actually try anything new, which is kind of normal for big companies, right?
Yeah,
big
it's all
companies
about
don't
incent.
really risk that much. Yeah. I feel like, and I don't know if you read Nassim Taleb, he came out with this thesis and said, well, we really have to look into individual entrepreneurship in the sense of risk taking, right? So we have to take a risk, do something useful for society, and then we scale it up so everyone in the world can use this advantage that you've come up with, right? It could be on Reddit, it could be anywhere. It doesn't have to be an actual business, but it's a personal risk that people take. Do you feel like, and he makes it sound like this is a big part of the missing productivity growth, that there's not enough distributed risk taking, but obviously his book is about fragility. Do you feel like that's something when you look at people, and you just mentioned your friend from Facebook that you follow on Facebook, do you feel like we're returning the corner there as well, where we see this individual risk taking is really carrying on in the 20 to 30-year-old group, or that's something that's still kind of alien?
I mean, I think it's just a function of the capital markets, because I saw this before. I saw this in the .com bubble, and you had a bunch of people trading and participating in the markets, and that was a short period of time that lasted for a year or two, and then it disappeared. So I think the same thing is going to happen.
Yeah. But that's on the trading side, people who buy stocks, right? But people also take individual risks. Like they innovate something, they put some code in GitHub, right? They come up with a little piece of knowledge that the whole humanity can use. I mean, that's kind of what we want, right? So we have a bunch of people who go out there, slay the dragon, but we have lots of dragons out there, and then they come back and give us the gold. I think that's kind of the metaphysical idea how we can fix productivity growth.
I don't know if there's more or less risk taking now than 10 or 20 years ago. It's kind of hard for me to tell. If you look at a chart of business formation, it's absolutely exploded in the last year. And a lot of that is, out of necessity. People lost their jobs during the pandemic. They had to do something, so they started a business. But I tend to think that we still have, pretty good amounts of risk taking in our economy.
Yeah, but it's very hard to tell. There's no good statistics for it, right? So it's definitely a bit of a gut feeling. I would agree that people are seeking out way more and more that way, but there's definitely a financing issue. But we see tons of early stage financing, right? That's we call it the bubble. That obviously there's not billions of them that are being funded, but it is a bubble in terms of valuations, the ones that have potential to become a unicorn. But in between, there isn't a ton. That seems to be the issue right now. But at least there's a ton of early stage funding for startups.
Yeah, I mean, if you go back to I think it's actually gotten better. I think in 2018, you saw some pretty crazy valuations of startups. The scooter companies, so Bird and Lime, had multi-billion-dollar valuations. You saw the dog walking app Wag have a $1 billion valuation. That's kind of come down over time. A lot of this was driven by a rush into VC funds and also SoftBank. SoftBank alone is probably about 50% of the VC market and push valuations higher. So
yeah, it's definitely the 500-pound gorilla there. Stephen told me this in the last episode, that there's a Chinese investment vehicle that has about $1 billion. No, is it $1 billion? $1 trillion worth of firepower that invested over the last 5 years already. So it's basically 5 times the size of SoftBank. I think SoftBank's $200 billion, right? 2 $100 billion funds.
I didn't hear about that. I didn't hear about that.
Yeah, so it's some state-run vehicle, and that's where this bubble came upon, right? This giant enormous bubble in Chinese tech that
Wow.
seems to be deflating now. Who knows?
Yeah.
Maybe it's just momentarily a buying opportunity. It's just buying the dip. Well, when you look at stuff that's not crazy overvalued, where you feel like this is an opportunity to go long, where would you look right now? Is it energy stocks, for instance? That seems to be, well, when I talk to seasoned investors, they keep telling me about energy stocks and seems to be very undervalued. But where are other opportunities where you feel like people should take a look at?
Energy, basic materials, agriculture, real estate, any inflation sensitive stuff.
Yeah.
Energy's had a nice little pullback in the last month or two, which provides a pretty good entry point. I mean, I was early on the energy trade. In fact, a little bit too early.
Yeah.
I got involved before oil prices went negative, so that I had a rocky start to that trade.
Yeah.
But that's worked out beautifully, and I expect that it's going to continue to work out. A lot of people like the uranium trade. I think that's got a lot more legs in it. Trying to think of what else. Financials look pretty good. If you think that rates are going to go up, which I think they are, the curve will get a bit steeper. Banks, insurance companies, stuff like that. And you've seen some of the things you've seen in the last couple of days in tech. You saw some big earnings beats and stocks trade down off of earnings. So, look, I'm kind of a one-note Samba. Like I say the same thing all the time. You want exposure to inflation and you want exposure to value. And I think that's going to work for the next 5 years.
Yeah. And you would keep saying that despite being, we see this trend following where we see these massive companies that don't really fit into the value characteristics at all, right? We see Tesla that has no value to it from a value investor standpoint, and seems to be skyrocketing or has skyrocketed over the last 24 months. You feel like the growth is, or we will see a mean reversal, right? So the value stocks have done really not so well the last 2 years. We'll really see the heyday in the next couple of years.
Oh yeah, absolutely, yeah.
Yeah. That's interesting. I mean, it's definitely a tough position to be in, because if you've done this the last 2 years, then you're sitting on some losses, right?
Well, I haven't been doing it the last 2 years. I've been doing it about the last 9 months, and
Okay.
it's done pretty well so far. So
Yeah. One thing that goes a little bit outside of finance, maybe I wanted to pick your brain on, is a bit finance. It has this history of really steep innovation, right? It comes out investment, comes up with a new structure of product, right? And we had sort of CDOs, and it has this massive amount of basically it sets up a bunch of contracts, and we'll have a new product, and we have this completely new environment. Do you feel like this? But it seems a bit of like a zero-sum game, right? It seems like an empty innovation that's being done, because it seems the investment banks win, right? But nobody else. It doesn't really leverage itself out into the economy in terms of capital allocation. Is that something that you would share? This agreement that investment banks innovate, but their innovations are like really, they're basically to their own benefit, and they never really make it all the way into the economy.
no, I would disagree with that. I mean, there's a lot of people. I never wrote about this, but there's some people out there who have written about the financialization of the economy, right?
Yeah, exactly.
And there are very few good financial innovations. And if you go back over the last 100 years, probably the biggest one is the 30-year fixed rate mortgage, right? That enabled 70% of people in the country to own a house. That was a good innovation. Also in the mortgage market, the mortgage-backed security was a good innovation. Securitization was a good thing for the mortgage market. It made the mortgage market more liquid. It lowered rates. So I think that was a good thing. When you start talking about, things like CDOs and complex derivatives, I like to call that unicorn piss. That's just complexity for the sake of complexity. And I think when it comes to financial innovations, like, complexity is really the enemy. And I really, I don't know. I mean, I hesitate to say this, but I think in the last 100 years, I think we've thought of everything. I don't think there's any more ways to slice and dice what we already have. I don't think there's going to be much in the way of financial innovation. And I think that's kind of reflected in the stock prices of the banks, which haven't really, they've done okay, but they haven't really done all that well since 2007, 2006. So, yeah.
It seems like investors assume there is some negative surprises in these balance sheet and these P&Ls. But that's kind of my theory, my personal theory, of why people are not so bullish on financials. When you look into the world of DeFi, decentralized finance, right, crypto, do you think it's and I think we both will agree that it's a bubble, but do you think it's a crazy bubble? It has the potential to really basically get rid of all the banking out there, right? It's all the banking become computers, right, that run in the cloud, that run on the blockchain. Do you think that's realistic?
I think it's realistic 20 years from now. And this is the cycle that all new technologies follow, right? So you have a new technology like the internet back in the late 90s, and you had this massive investment bubble, and then it deflates. And then you have this period of time over the next 10 or 15 years where people forget about it. Okay.
Yeah.
And if you look at a chart of the NASDAQ over the last 20 years, that's what happened. It peaked in 2000, it bottomed in 2002, and then it didn't do anything for 10 years. So I think Bitcoin is going to, not just Bitcoin, but crypto and DeFi is going to follow the same pattern. I think we are in the midst of a bubble right now. I think 2 or 3 years from now, people will have kind of forgotten about it, but these are important innovations. And 20 years from now, we might have the ability to do this.
Yeah. Yeah, I mean, it's the whole, we kind of have this almost Soviet-style state-supported banking system, right? So if you set these interest rates, and we're kind of very interested in the stability of the banks and how they run their business, which is very anathema to an open market economy, right? But we've been so concerned, and we've been burned in 2008 by exactly that. And I think DeFi is would absolve us of this responsibility, right? So we just push it to the blockchain and say, okay, well it's going to work, right? Do you see that's a possibility that we kind of leave all this regulation behind on this very static banking industry, and we go to something that's much cheaper and much faster, and basically zero transaction costs?
I mean, the best product doesn't always win. Okay,
long term it should, no?
I mean, it should, but the best product doesn't always win. So,
true.
I mean, maybe over a long enough time horizon. I just think it's going to take a really long time. I think people are a little overly enthusiastic about it right now. It's 2040 is when we should be talking about this. Yeah.
2040. Have you heard of the singularity, Ray Kurzweil's theme?
Yeah.
What do you feel? It's because you just mentioned 2040. Do you think there's more happening in 2040, or it's just like because you think it's a 20-year cycle?
A 20-year cycle, yeah.
Okay. Yeah, because there's so much tech that could kind of change our life forever. Kind of what we said about the internet, and it kind of did, right? But it took much longer to change people as well.
Yeah.
It took 15, 20 years to actually make their minds change. Another thing is, we have finance, we have as an innovation, but it's also often a starting point of, we see if complex systems that we adopt. Think about socialism, capitalism, how much state-run an organization should be. We see it manifesting in finance, right? So when you go to Europe, you have the regulations that you see in the financial markets are extremely, well, I would say comprehensive, right? So banks are basically a piece of the government. That is to an extent true in the US as well, with certain credit unions, but I think investment banks shows that there's another world to this. Do you think finance is a good indicator of how well an economy does? So we compare different countries. Would you feel like we can analyze just the financial industry and then see, well, this is what we see in the financial industry, and that's why we feel like this country is relatively developed, relatively free market, or that's not a good indicator?
I think it's a good indicator. I mean, I can't think of too many times in history when the economy has done well, but the banking system is not. The banking system has always been, an indicator of the health of the economy. So,
Yeah, I've been reading Ray Dalio's book, right? So his thoughts about these 90-year cycles, and that basically it's a currency cycle, but obviously the banking system is very much involved in this. And it's how currency, goes through a crisis and then becomes really strong again. And the banking system is certainly a reflector of this. So he doesn't really mention it, right? So it seems so hard to value the banking system or banks at all because all their P&L statements are based on the market, right? They value it against the market, which is what they should. But if the market changes or moves by 50%, then their P&L is worthless.
Yeah, I don't have any ideas on that. I don't.
Yeah. Yeah, it's leading relatively far out. Anyways, it's kind of all I had, Jared.
Oh yeah.
Yeah,
Okay.
that's kind of all I had. I don't have a ton more questions. I think we've been much quicker than I thought. It's been only like 30 minutes, right?
Yeah, I'm pretty succinct with my answers. So
Yeah, I noticed that. I noticed that you're very clear. You know what you want. I think this is awesome. And not a lot of people, have that in generally, but especially in the financial industry.
yeah.
Well, one more thing that I had, and we can make a few cuts here. Personalities, and I think finance is really driven by by major personalities. Who are people that you admire, right? People that you listen to, but you also admire because they've done something incredible in the industry. Who do you listen to?
I had a boss at Lehman Brothers who was very, very smart and also very, very ruthless and very, very focused. And he's been very successful in the industry. And he was a mentor to me. He put me in charge of the ETF desk. He gave me complete freedom to run it. And he was a terrific guy, and I have a lot of respect for him. Trying to think of,
Yeah.
I mean, in terms of trading, of course, like, a guy like Stan Druckenmiller is the king. And, I've read a lot of the things that he's written or said, and I've tried to emulate my trading style off of him. Not as successfully. He's better than I am, but I guess that's about it.
Yeah. Yeah. There seems to be a certain mindset, and I find that sometimes quite interesting. There's this mindset of, there's impending doom, and there's people who always go out with the opinion of the impending doom, and obviously they're right because doom is always coming, right? So there's always the day where the market crashes. I think that's the cycle part, right? The Fed can do whatever they want. Maybe the Fed can actually solve that problem, but I guess we're just going to make it worse if we keep throwing money that way. But I'm curious from how when you look at commentators, there seems to be a part of that market that is very very stable, very static in their opinions. They have a similar prediction whenever you ask them. And then there's people who change their prediction on the other end of the spectrum, like in an instant. There's this I think it's an analyst. I forgot which bank he was working on. He literally made within 4 weeks the prediction that Bitcoin, when it was still going up, hit 150,000. And then 4 weeks later, he changed his mind and said, "Oh, it's going to go down to 15,000 because the market." And what changed? And the market action changed, right? The movement, they're basically trend following the trend where Bitcoin is headed was changing.
I have some thoughts on this. What's interesting? So, as you said, I'm sort of a financial personality on the internet. And, it's a competitive market. There's a lot of people offering commentary and advice. And the people who are most successful financially at doing what I do never change their minds. Never change their minds. Take a guy like Lacey Hunt, okay? He's been saying interest rates are going lower forever. He's been saying we're having deflation forever. He hasn't changed his mind. He has followers. He has disciples. He has people who hang on his every word because it's this one view that they believe in. And I'm more in the second camp. Like, I change my mind all the time. I can believe one thing one day, and a couple of weeks later, I can believe the exact opposite thing. And in terms of my business, in terms of running a newsletter and getting subscriptions, it's actually not that good of a thing because, people want you to be consistent over time. But, the markets, they have this property called non-stationarity. It's a game where the rules are constantly changing. Okay. So you can do one thing in the markets and it works for a while, but then the rules are going to change and you have to do something different. So you have to be very adaptable, but it's not, it's not really conducive to selling commentary or advice.
So would the answer be that if you come to a certain conclusion, and let's assume you're right with that. You just have to like wait out the trade, and as longer you can wait out the trade, is better. And I always see this with Warren Buffett. I think a lot of people are overlooking that fact. He didn't do much in his youth, right? In his 20s and 30s. I mean, he did stuff. He educated himself, but he wasn't like a magical investor. And he started investing, and nothing happened for like what 10, 15, 20 years. And then suddenly it really became a bigger numbers, and now the numbers are massive. But what I think is so unique about him is that he basically has one similar. It has changed over time and morphed, but he has one similar investment style. But he's seeing the returns now compounded over 50 years, and that's what's giving him these big numbers. And he had to be very consistent to execute this. So is that the right theory? You come to a certain conviction, and then you just wait for it to come true, and hopefully you're still alive when it comes true.
So there's two parts to that, and one part of it is you need a lot of patience. And Warren Buffett that's his one virtue more than anything. He has a lot of patience, and you also have to manage risk and conserve capital so that when your trade is out of favor, which it inevitably will be, you can manage your drawdowns and stay in the trade.
Yeah. But it's psychologically so hard, right? Because that might mean for 20 years you don't see anything in your P&L, the only losses.
Yeah. No, I mean, not many people can last 20 years. I mean, you probably saw, you heard about this, a guy named Charles DeVoe. Have you heard about this?
I have not.
He was, what was the name of the firm he ran? International Value Advisors, I think, IVA. He was a value manager, a deep value guy, almost distressed, but like a deep value guy. And, back 20 years ago, he had assets of 20 billion and it went down to 1 billion. And after 20 years, he climbed to the top of a building and jumped off and he committed suicide. Yeah. I mean, basically right when value just started to outperform. So, I mean, it's brutal. Like it takes an incredible amount of patience and an incredible amount of conviction to say that, I'm right and I'm going to stick through this no matter what happens. Just on a micro level, I'm in the inflation trade and that's been out of favor for the last couple of months. And that's been a little bit difficult. I've taken a drawdown of about 6%, which is pretty manageable, but price determines your mood. And it's very difficult to hold that kind of conviction when you're sustaining losses like that.
Yeah. It's kind of a buy and forget, right? You should almost never look at your portfolio again.
Yeah.
If that's your strategy, right? Where you accept massive drawdowns if you feel you're going to be vindicated once that day comes. And it's unpredictable when it comes. I think, well, when I see, the Eric Wiener had that book about the dead philosophers, the most famous philosophers are dead. And unfortunately, it takes a long time for your fame to outlive yourself. I feel like this is what very convicted investors are in a similar position, right? They build their philosophy, they hang on to it, and they're probably right, but in their lifetime, they only see the negatives in terms of social recognition because they don't get any, right? Everyone hates them and they're an outlaw. But then they really have to wait until the end, or often they don't even see it in their lifetime to see being vindicated and being right.
Yeah. Yeah.
That seems to be terrible. I mean, it's a predicament, right? You don't want to be depressed for the next 40 years because you only have one life, even if you're right. Yeah, I find that an amazing trait.
Yeah.
That you can be in such a position for so long and keep that conviction.
Yeah.
It strikes me as something supranational. It's like coming out of a different sphere. It's why go through all this trouble? Like if you don't necessarily wouldn't get a return, it's almost religious, right?
Yeah. Yeah.
There seems to be a connection that people don't really make. So I feel like there's a connection between religion and these very stoic investors in the industry that, as you said, haven't really changed their mind and are willing to sit it out forever.
Yeah, I don't like taking drawdowns. I'm a little bit of a wimp, so I have the ability to change my mind. But with regard to the inflation trade, I mean, I think this is a secular trade, and in the context of a couple of months, I think that's a pretty short time amount of wait. So I'm willing to stick through it.
Yeah. Well, there's a huge amount of of research that we know, right, about that technologies are deflationary, and that all the countries besides China, and obviously China is very deflationary, all the other countries in Africa are coming online one day, and it keeps continuing. But we print so much money, it needs to go somewhere, right? So for me, it's really mesmerizing. Where's this black hole? We can say, yeah, asset prices, certainly, but it's just this massive amount of money that we printed, 60% of all the dollars ever in the last, 18 months?
Yeah.
But where did they go? It cannot be 5% inflation. That's nothing.
Yeah. It's again.
Did we ship it off somewhere, like
it's
to another country?
It's not about money supply. It's not about any of these variables. It's not about productivity or China or anything. It's about psychology. It's 100% about psychology.
Yeah. See your argument. I mean, that's certainly true. You know, if we all outrun each other, it's gonna be a big stampede. Everyone wants to be first.
Yeah.
I'm gonna find a way to spend money. Jared, that was really interesting. Thanks for sharing your thoughts. Thanks for coming on the podcast. I like your really succinct answers. You know what you want. I love that.